Over the past month, Applied Materials is up by more than 10% if we account for today's pre-market. But over the past 6 months, they're actually down by 24%. Now, potentially, AMAT might be currently undervalued, because when we have a look at its PE ratio, we can see that currently it is sitting nice and low. So AMAT is one of the few tech companies that are currently not overvalued compared to the earnings they generate. So jumping to my stock valuation spreadsheets, I will plug in AMAT sticker and wait for all the metrics to show up. Now, as always, if you find these spreadsheets helpful and interesting, you can download them at the link in the description. Now, the first thing I love about this company is their low trailing free cash flow payout ratio, sitting at only 16%, which means that after paying out their dividend, they still have a lot of free cash flow left over they can direct into share buybacks, paying down debt, and innovating, which is extremely important, especially for AMAT, which is in the technology sector. Now, you have probably noticed their low dividend yield sitting at only 0.86%. But when I jump to the 8th pillar, you can see that their 5-year dividend growth is sitting at 12.15%, which is more than 3 times the average stock year-over-year dividend growth. And over the past 5 years, they have actually grown their dividend by more than 90%. Now, what you have to understand is that high and consecutive dividend growth is much more important than high dividend yield. If I jump to the dividend yield tab in Seeking Alpha and scroll down to the yield on cost tab, if you invested into the company 10 years ago, your yield on cost would be sitting at around 7%. And if you invested 30 years ago, your yield on cost would be sitting above 60%. And this is the power of high consecutive dividend growth. And that's why this company might be great for dividend investors that want to achieve the dividend snowball effect in their portfolio. Now, jumping straight to my 9-pillar analysis, you can see that AMAT gets a rating of 9 out of 9 with all the pillars currently sitting in the green. Now, let's first have a look at the growth of the company. Their 5-year revenue CAGR is sitting at 10.24%. Their 5-year free cash flow CAGR is sitting at 25.25%, and their net income CAGR is sitting at 16.65%. If I zoom into these 3 pillars, you can see that the revenue grew from 17 billion in 2020 to 27 billion in 2024. The net income grew from 3.6 billion to 7 billion, and the free cash flow grew from 3.3 billion to 7.5 billion in 2024. Now, you have probably noticed that over the past 2 to 3 years, the profit growth has been slowing down. But this doesn't really bother me that much, because with the huge tech boom we are currently experiencing, the company will always have some sort of growing profit. And actually, if I jump back to Seeking Alpha and have a look at the earnings estimates, you can see that the earnings per share are expected to grow very continuously into the next few years. And that is the same case with the revenue, which is expected to grow by 8% in 2025, by 7.5% in 2026, and by 5% in 2027. So I really wouldn't be worried about their profits growth. And talking about profits, actually, if we have a look at their 5-year profit margin, that is sitting at 24.83%, which is nice and high and shows me that they are managing their costs very well and therefore generating a good amount of net income. Another thing I love about the company is that they have been decreasing their shares outstanding at a nice rate of 2% yearly. If I zoom into pillar 7, you can see that they have decreased their shares from 923 million in 2020 to only 834 million in 2024. And the reason why I love when a company decreases their shares outstanding is because it increases their earnings per share. What you have to understand is that a company's increasing value is best determined by the increase in their earnings per share. So you can see that AMAT has increased their earnings per share from about 4 in 2020 to 8.61. So the company's value has been increasing, but their stock price has been increasing as well. So let's have a look if the company would be considered undervalued compared to their 5-year earnings and compared to their 5-year free cash flow. If we jump back to pillar 1 and scroll up, you can see that the current PE ratio is sitting at 22.08, which is higher than the 5-year average, but it is well in the range we would like it to be in. So the company might currently be very fairly valued compared to the earnings they are generating. Now, regarding their price to free cash flow, if we jump to pillar 7, you can see that that is currently sitting at 21.17, which again is higher than the 5-year average and is slightly higher than the average stock price to free cash flow, but again is very close to the value. So we can say that AMAT is very fairly valued compared to the free cash flow they are currently generating. Now, the last thing I want to have a look at is how much debt AMAT currently has. If we have a look to the 9th pillar, the long-term liabilities over the 5-year free cash flow negative dividends, you can see that currently that is sitting at only 0.29, which is well below 3, and tells us that the company generates enough free cash flow to cover all their dividend payments and pay down all their long-term liabilities in about 2 years. So after going through the 9-pillar analysis, AMAT really looks like a great company all around. They have a low 5-year P/E ratio and a low 5-year price to free cash flow. They have very decently growing profits. Their profit margin is sitting nice and high. They are decreasing their shares outstanding. They have almost no debt, and their dividends are growing very, very well. To be fully transparent, I do currently own shares of Applied Materials in my portfolio. I bought into the company about 2 months ago, and I'm planning to hold into the long term. But now let's figure out if the company is still a buy at its current trading price. So first, jumping to the grams formula revised, we have to plug in the 5-year earnings growth estimate. Now I have plugged in my high earnings per share growth estimate at 10%, medium at 8%, and low at 7%. I then averaged this out with the analyst projections and got a 5-year earnings growth estimate of 9% into the next 5 years. I then combined that with the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and got an intrinsic value of $148.13, which is actually almost 30% lower than the current trading price. Now, as I mentioned in some of my prior videos, the current yield on AAA corporation bonds is currently much higher than the short-term average of 3.5. Now, as I do believe that this value will lower within the next years, I will plug it in at 4, and we will get an intrinsic value of $182.57, which now is only 4% lower than the current trading price. Now, for the second valuation model, I will look to the discounted cash flow model. We will plug in the free cash flow over the past 5 years and calculate an average growth rate. Now into the future, I will predict a growth rate of 8.3%, and using this, I will calculate the present value of that future free cash flow. Then plugging in a discount rate at 10.2%, I will calculate the present value of that future free cash flow and get an intrinsic value of $209.56. Now for the third valuation model, I want to compare AMAT to 3 of its competitors, so Lam Research, ASML, and Qualcomm. I will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. I will then average them out and multiply by the earnings per share of AMAT to get an intrinsic value of $247.51, which shows us that the company is undervalued compared to its competitors. Now let's jump to the final valuation model, the dividend discount model. And here I will plug in the dividend growth over the past 5 years and calculate an average growth rate at 15.19%. Now into the future, I will project a growth rate of 12.33%, but as this is higher than our discount rate, the intrinsic value will come out negative due to the mathematics within the dividend discount model. And therefore we will use our alternative model, which will give us an intrinsic value of $245.47. Now, when we average out these 4 valuation models, we will get an intrinsic value of $221.31, which is still 16.63% higher than the current trading price of the company. And with a margin of safety of 15%, we would get an acceptable buy price at $188.11, which is very close to the current trading price. And with that, I hope that you enjoyed the video. Make sure to let me know down in the comments if you are buying, selling, or holding AMAT, and make sure to leave a like and subscribe as it really helps me out.